The median 401k balance for Gen X, the generation literally next in line to retire, is $67,100. The magic number Americans say they need to retire comfortably in 2026 is 1.46 million. That is a gap of $1,392,900. And most of those people have roughly 10 years left before they expect to be done working. Let that land for a second. Nearly 2 in 3 Americans, 64%, worry more about running out of money than they do about dying. And based on the actual retirement mechanics, that fear is not irrational. It is calibrated. Here is what none of those headlines tell you. Your 401k balance is almost certainly lying to you right now. Not because the number is wrong, it's correct, but because the number is almost completely irrelevant to whether your money makes it to the finish line with you. What actually determines that are 3 structural realities most plans never account for. And at least one of them is probably already embedded in yours. Here's the thing. The entire public conversation about retirement savings is a balance conversation. How much do you have? Are you on track? What's your magic number? But fixating on the balance is the wrong question, framed in the wrong direction. You could hit the exact number everyone says you need and still run out of money in your 70s. You could have less than advisors tell you is necessary and actually be fine if the mechanics of how you draw the money down work in your favor. I'm going to walk you through 3 specific structural signs that 401k accounts run out before people die, not fear bait mechanisms. Each one is checkable right now against your own situation. If any of these 3 signs are present in your current plan, your number is probably wrong and the fix is smaller than you think, but it has to happen before you flip the switch. Think of your retirement savings as a bucket. You spend 30 or more years filling it, your contributions, your employer's match, market growth, compounding, and then one day you flip it upside down and you spend the rest of your life drinking from it. Every financial advisor, every HR department, every YouTube channel, including this one, is obsessed with one question. How full is that bucket when you flip it? But 3 things determine whether the water runs out before your thirst does. First, the size of the hole at the bottom, how fast you're actually pulling money out, and whether your extraction rate is built for reality or for a spreadsheet. Second, whether someone bumps the bucket right at the moment you flip it in the market, doing what markets do, at exactly the wrong time in your retirement timeline. Third, whether you actually got to fill the bucket as long as you planned because something stopped you early. Every sign I'm going to show you tonight is one of those 3 things, and I'll be specific enough that you can check your own plan against each one before this video is over. Let's start with the one that has the most hidden momentum. In a few minutes, I'm going to show you why the withdrawal formula most people are relying on was designed for a world that hasn't existed for 20 years. But first, let's talk about the sign that can destroy a plan even when the balance number is exactly right. Sign number 2 is this. You think your average rate of return determines your retirement success. It doesn't. What matters far more, and this is one of those reversals, where the real problem is almost the opposite of the obvious one, is not the average, but the order. Here's a story. 2 brothers, Steve and Paul, both retire at 65 with $1 million in their 401k. Both invest in a portfolio that over the next 18 years averages exactly 6% annually. Same average, same starting balance, same withdrawal amount, $50,000 a year, adjusted 2% annually for inflation. 18 years later, one of them is fine, the other one is broke, account at 0. Age 83. The difference was not discipline, not intelligence, not even investment selection. Steve retired in a year when the market had a rough start. His portfolio dropped 15% in year 1, 12% in year 2, because he needed that $50,000 to live rent, food, basic reality. He had to sell shares while they were down, not because he panicked, because he needed to eat. And selling shares when they're cheap means you sell more of them to raise the same dollar amount, which means when the market recovered, and it did, Steve had fewer shares left to participate in that recovery. Each year of continued withdrawal on a recovering but depleted base His effective withdrawal rate as a percentage of his actual portfolio kept climbing. By year 8, Steve wasn't withdrawing 5% of his portfolio. He was withdrawing closer to 11. The hole at the bottom of the bucket got bigger every year that started badly. Paul had the same portfolio, same average return over 18 years. But Paul retired into a strong market year, up 21%. He barely touched principal in year 1. His base compounded aggressively before serious drawdown began. The market dropped for Paul too. In years 10 and 11, same magnitude, but by then, his portfolio had so much growth buffer built up that the same percentage drop in absolute terms was survivable without permanently altering the trajectory. Same average returns. Wildly different outcomes. The only variable was the order of those returns. Research from Morningstar found that if your portfolio drops by at least 15% in your first year of retirement, while you're also withdrawing around 3.5% of your balance, you increase your odds of depleting that portfolio within 30 years by 6 times compared to someone who had a first-year positive return. 6 times. Not 30% worse. 6 times more likely to go broke. Your first 5 years of retirement are the danger zone for tapping accounts during a downturn, according to Morningstar's portfolio strategist Amy Arnott. A major drop in the early years of retirement can scramble the entire picture. When you tap into your portfolio as it's losing value, you have to sell more investments to raise a set amount of cash, and that not only drains your savings more quickly, it leaves you with fewer assets that can generate growth during future recoveries. Financial planners call this the sequence of returns death spiral. The 2000 dot-com crash and the 2008 financial crisis provide stark examples. Retirees who began withdrawing from their portfolios just before those downturns faced devastating consequences. Even though markets eventually recovered, someone who retired in 2000 with a $1 million portfolio and planned to withdraw 4% annually saw their portfolio reduced by 40 to 50% after the 3-year bear market that followed, despite following conventional wisdom about safe withdrawal rates. Many of those portfolios never recovered to their original value, despite the strong bull markets that followed. The check you need to do right now: does your withdrawal strategy have any mechanism to flex downward if the market crashes in your first 3 years? If the answer is I plan to take 4% and adjust for inflation, you have the same plan that failed those 2,000 retirees. As we enter 2026, the economic landscape has shifted. With equity valuations approaching historic highs, a rigid set-it-and-forget-it withdrawal strategy is not just outdated, it's dangerous. The bucket metaphor for this one: someone bumps the bucket right when you flip it. And unlike during your accumulation years, you don't get to wait for the water to refill. You need the water now. Stay with me, because this next part is where the average retirement plan has its quietest failure, and it is the one most embedded in mainstream advice. Sign number 1 is the sign I think is most misunderstood because it looks simple on the surface. You're drawing down at a rate your balance can't sustain, and the formula you're relying on was built for a world that no longer exists. Bill Bengen was a financial advisor in California who in 1994 published research that gave birth to what everyone now calls the 4% rule. His methodology was genuinely sound. He took 50 years of historical market data, modeled the absolute worst-case scenarios across every historical 30-year window, and found that withdrawing 4% of your portfolio in year 1, then taking that same dollar amount adjusted for inflation every subsequent year, had never resulted in a portfolio failing within 30 years. Never. Not through the Great Depression, not through the 1970s stagflation. Bengen gave retirees an answer to the question every retiree eventually asks: how much can I safely withdraw from my portfolio without running out of money? 4% in year 1, then that same dollar amount adjusted upward for inflation every year for 30 years. This became scripture. Every retirement calculator uses it. Your HR department has probably referenced it. Your advisor almost certainly quoted it to you at some point. Here is the problem. The 4% rule operates under the assumption that you have a portfolio that will last for 30 years. In reality, more than half of workers, 58%, retire earlier than they planned, usually due to unforeseen circumstances. The median age they actually stop working is 62 3 years shy of the traditional retirement age of 65. If you retire at 62 and you believe you'll live to 90, a reasonable belief given current life expectancy trends, you are not looking at a 30-year retirement. You are looking at a 28-year retirement at minimum and potentially a 33-year one. Morningstar analyzes the 4% rule every year. And it says that for a typical person retiring in 2026, the truly safe starting withdrawal rate is actually 3.9%, not 4%. For early retirees looking at 33-plus year horizons, the figure drops further. The younger you retire, the lower your safe withdrawal rate. For someone retiring at 40, you're looking at 2.5% to 3% maximum. A 0.5% difference sounds like a rounding error. It is not. Here's the math done clean. You have $500,000 in your 401k. 4% of $500,000 is $20,000 a year. 3% of $500,000 is $15,000. That $5,000 a year difference isn't just $5,000, it's $5,000 that isn't compounding in the market. Over a 25-year retirement, the difference between a 3% and 4% withdrawal rate can mean the difference between a portfolio that survives and one that fails by 81. And if you started withdrawing at 4.5%, which is what happens when healthcare gaps and inflation squeeze you, the failure point moves to 76. Then there's the tax reality, which gets ignored in a way that I find genuinely funny. Your traditional 401k balance is not yours. It is yours minus ordinary income taxes on every dollar you withdraw. When you pull $40,000 from a traditional 401k, that withdrawal is taxable as ordinary income. There is real concern that most people ignore the reality of taxes while trying to live by the rigidity of the 4% rule. If you withdraw $40,000 in the first year, you still have to pay taxes, so you don't actually have $40,000 to live on. Depending on your tax bracket, your $40,000 withdrawal becomes $34,000 to $31,000 in actual purchasing power. The 4% rule does not say withdraw 4%, then hand 15% of that to the IRS. It just says withdraw 4%. The tax reality quietly makes your effective withdrawal rate higher than you think every single year. This is where I want to introduce Marcus. Marcus is 54 years old, works in supply chain management in the Midwest, and has $340,000 in his 401k he's been contributing for 22 years. He plans to retire at 65. His current math says he'll have around $580,000 by then, assuming modest market growth and continued contributions. He's planning to withdraw 4% a year, delay Social Security until 67, and let the two combined produce a comfortable income. The math on a spreadsheet works. Marcus is the person this video is quietly following. We'll come back to him. The median retirement savings for people aged 55 to 64 is $185,000. And the magic number they say they need is $1.46 million. Among Americans who have retirement savings, 1 in 4 say they have just 1 year or less of their current annual income put aside for retirement. For Gen Xers, many of whom are approaching their retirement years, 52% have 3 times their current annual income or less saved. 3 times your annual income sounds like progress until you run the withdrawal math. If you earn $70,000, 3 times is $200. $10,000 at 4%, that's $8,400 per year from your portfolio. Supplemented by Social Security, maybe $15,000 to $20,000, you're looking at $23,000 to $28,000 a year in total retirement income before healthcare. Fidelity's annual study found that the average 65-year-old couple retiring in 2025 will need $345,000 saved specifically to cover their healthcare expenses throughout retirement. That number is not discretionary. It does not come out of your vacation budget. It is a mandatory line item on your retirement balance sheet that most plans treat as a vague afterthought instead of a specific allocation. The bucket isn't just smaller than people think. The hole at the bottom is significantly larger than the calculation assumed. By the way, hit subscribe if you want more of this, because the YouTube algorithm is indifferent to whether you ever see my videos again, and I genuinely find that concerning on your behalf. Here's the part that almost never makes it into a retirement calculator, and I say this as someone who has spent years reading SEC filings, earnings reports, and retirement research documents that most people do not voluntarily read for fun. Knowing these three numbers and actually building a system around them are two very different problems. Knowing that your withdrawal rate should be 3.5% instead of 4% does not automatically reconfigure how you're invested, how you're sequencing withdrawals across account types, or how you've allocated for the specific cost of healthcare before Medicare eligibility. I built something called the Exit Code specifically for this problem. It's a digital book, 8 chapters of pure research, no filler, built on 50 years of actual retirement data. And it contains a mathematical framework that takes the vague intuition of, I think I'm probably on track, and turns it into a specific date and a specific number. 2 things from it are directly relevant to what we're discussing right now. The first is the 4% trap section and the dynamic withdrawal method that replaces it, the approach that adjusts your extraction rate dynamically based on market conditions instead of locking you into a rigid formula. Designed for a 1994 world. The math on this significantly improves portfolio survival rates for people navigating the kind of volatile environment we're in right now. The second is the $14,000 invisible bill, the section that deals with the pre-Medicare gap that most standard retirement calculators simply do not model. That is the average annual cost difference per person when you retire before 65 without an employer plan. And it quietly consumes a disproportionate share of early retirement portfolios in years 2 and 3, compounding the sequence of returns problem at exactly the moment you can least absorb it. The exit code is available through the link in the description for less than a dinner out. It is built entirely on data because I am constitutionally incapable of trusting financial advice that doesn't have a source attached to it. Back to sign number 3. Because this is where, statistically, the actual damage to most retirement plans begins. This is where it gets really interesting. And also where, if you are honest with yourself, you might feel something that is not really about market returns. Sign number 3 is the plan itself. Specifically, the plan to work longer, keep contributing, and use extra years in the workforce to close whatever savings gap remains. It is the single most common retirement contingency plan in America, and the data on how often that plan actually executes is brutal. The 2025 EBRI survey found that 40% of retirees left the workforce earlier than planned. Among those who retired early, 44% said they could afford to a positive outcome. But 31% cited a health problem or disability as a reason for their earlier than expected departure. Another 31% pointed to changes at their company, such as layoffs, downsizing, or business closures. Factors beyond an individual's control were responsible for 76% of early retirements in 2025, according to EBRI. They included health problems and disabilities, and company changes such as downsizing, closure, or reorganization. Research from the Urban Institute found that more than half of full-time workers in their early 50s eventually leave their jobs involuntarily due to layoffs or other employer-related reasons. For those who do find new employment, it often comes with significantly lower pay. Think about what that means for Marcus. He is 54. He has a plan that depends on 11 more years of contributions. The Urban Institute data says more than half of people like him in that age bracket get pushed out before the plan completes. Not because they lack resolve. Because the company restructures, the health issue lands, the body stops cooperating with the schedule. In the 2025 EBRI survey, 75% of workers said they plan to work for pay in retirement. Only 29% of retirees reported actually doing so. The gap between what workers plan and what retirees experience is not a motivation gap. It is a structural gap between intention and reality that has remained stable for more than 20 years of data. And when the forced exit happens, when retirement arrives 3 years ahead of schedule, it does not arrive alone. It arrives with the healthcare bill. Health insurance can represent one of the largest expenses for individuals who retire before 65. Monthly premiums of roughly $1,000 to $1,100 per person can meaningfully affect how long retirement savings last, especially when combined with other core costs. Without a subsidy, ACA Marketplace premiums for a 62-year-old typically run $1,000 to $1,800 per month in 2026. That is $12,000 to $21,600 a year per person just in premiums before deductibles, copays, or anything else your body decides to charge you for. A couple retiring at 62 without access to income-based subsidies, and many early retirees end up above the subsidy threshold simply because they're drawing from a traditional 401k. Could be looking at $24,000 to $40,000 a year in healthcare premiums alone for 3 years before Medicare eligibility begins. Now, you're not withdrawing 4% a year. You're withdrawing whatever you need to survive, which is more. Sign 3 is feeding sign 1. The hole in the bucket gets bigger right at the moment you flipped it. There was a woman named Robin DeLucia whose story was documented by the Pew Charitable Trusts. Robin had to re-enter the workforce after initially retiring at 70 because she couldn't live on her nest egg. She is not alone. Nearly a third of retirees are considering going back to work for the same reason. Their savings aren't enough to cover their expenses. She retired at 70. She planned carefully. She followed the conventional wisdom. And the mechanics still failed her. Now you're asking yourself, what if I'm somehow avoiding one of these 3 signs? What if my balance is large enough to absorb a bad market year? Or my withdrawal rate is genuinely conservative? Or I really can work until 67? Here is the thing. These 3 signs don't operate independently. They interact. And when they interact, the math doesn't get linearly worse. It gets exponentially worse. The Goldman Sachs 2025 retirement survey captured something striking. 68% of working respondents said they were confident they would meet their retirement goals. At the same time, 58% believed they would outlive their savings. Goldman Sachs called this the Optimism Gap, the split between how workers feel about their progress and what they fear about the future. The reason both things can be simultaneously true is that people are measuring their confidence by the balance of the size of the bucket, while their fear is tracking something else entirely, the mechanics of how it drains. Let me build you the specific scenario with Marcus, now that we know all 3 signs. Marcus is 54, $340,000 saved, plans to retire at 65 with roughly $580,000, assuming consistent contributions and modest market growth. 4% withdrawal. Social Security at 67. The spreadsheet says yes. At 61, Marcus's company announces a restructuring. He is offered a severance package. He takes it because the alternative is a lateral move with a pay cut and a reporting structure he finds untenable. His retirement starts at 62. He has $520,000 in the 401k, slightly less than projected because his final years of contribution were disrupted, plus $25,000 in cash. He is not eligible for Medicare. His ACA marketplace premium is $1,150 per month, $13,800 per year. He had budgeted $7,000. He is $6,800 short per year before he has paid for food, housing, or utilities. To cover the gap, he pulls more from his 401k than planned. Instead of $21,000 in year 1, he withdraws $31,000. That's a 5.9% withdrawal rate on $520,000. Then, in year 2, the market corrects. Income needs often stay constant, even when markets don't. If you need $50,000 a year from a $1 million portfolio and it drops to $850,000, your withdrawal rate rises from 5% to nearly 6%. This can accelerate portfolio depletion unless offset by new contributions, higher returns, or reduced spending. Marcus's $520,000 drops to $421,000 after a 20% correction. He still needs $32,000 to live. His effective withdrawal rate is now 7.6% of his actual portfolio value. Each withdrawal from a shrinking portfolio takes a much bigger percentage bite out of the nest egg, speeding up its decline. A smaller asset base simply can't generate the same powerful compounding returns for the rest of retirement. This is exactly how 2 people with identical starting portfolios and the same average return over 30 years can end up in wildly different places. One might leave a generous legacy, while the other runs out of money far too soon. By year 5, Even with market recovery, Marcus's compounding base has been permanently reduced. The portfolio recovery happens, but Marcus owns fewer shares than he would have if he'd never had to sell during the down period. By 69, his modeling shows the portfolio running to zero by 81. And here's the final layer. Marcus had planned to delay Social Security until 67 to maximize his monthly benefit. At 65, his cash buffer is gone and the portfolio drain is accelerating. He claims Social Security early at 62 and takes a 30% reduction in his monthly benefit compared to what he would have received at full retirement age. Federal data show that the main Social Security trust fund is on track to be depleted by 2033 when today's 59-year-olds reach full retirement age. Marcus claimed early into a system that may itself face automatic benefit cuts. He claimed what he was afraid of losing. That fear cost him roughly $140 a month for the rest of his life. None of these three events individually would have sunk Marcus. Together, in sequence, over 4 years, they turned a solid plan into a crisis. Here's what the corrected version of Marcus's plan looks like. Not more savings, the time for dramatically more savings is past. 3 structural changes to the mechanics. First, Marcus tests his plan not at 4% withdrawal, but at 3%. And not from age 65, but from 62. If the plan fails that stress test, which it does, he knows his contingency is already broken before the emergency exists. The buffer has to be pre-built. A conservative withdrawal rate in the early years of retirement reduces how much you need to sell in a down market, which can help your portfolio recover more effectively when market conditions improve. Second, Marcus maintains a separate cash buffer, 2 to 2.5 years of actual living expenses in short-term treasuries that are completely outside his equity portfolio. A retirement strategy known as the bucket approach can shield a portfolio from stock market losses. Keeping 1 to 2 years of living expenses in cash means these funds are accessible during market dips, so you're not forced to sell equities. This is the only reliable structural defense against sequence of returns damage. Not bonds, not target date funds. Actual cash equivalent liquidity. If the market crashes in year 1, Marcus lives on the buffer and sells 0 shares until the portfolio recovers. Third, Marcus calculates the pre-Medicare healthcare gap before he sets his retirement date, not as an afterthought, but as a primary budget item. He runs his zip code and expected income through the ACA marketplace calculator. He discovers his projected subsidy. He structures his 401k withdrawals and Roth draws specifically to keep his modified adjusted gross income below the subsidy threshold. The difference between landing just above and just below that threshold can be hundreds of dollars a month in premiums. That is a plannable variable, not a fixed fate. Your average financial advisor, by the way, charges 1% of assets per year for advice that often amounts to stay the course and max out your contributions. On a $500,000 portfolio, that is $5,000 a year. Over a 20-year retirement, assuming the portfolio generates no growth at all, which it will, you've paid $100,000 for the advice to hang in there. I am not angry about this. I find it genuinely funny, in the way that things are funny when the absurdity is so systematic that outrage would be exhausting. So, Marcus knew 3 things going in that most people don't check before they exit. He knew his actual safe withdrawal rate for his actual timeline. He knew his sequence of returns vulnerability window, and he knew the exact dollar cost of the gap between his planned retirement age and Medicare. With those 3 numbers in hand, he rebuilt the plan 3 years before the forced exit happened. Not perfectly, nothing is perfect, but defensively, the bucket had a crack. He patched 2 of them before winter arrived. 3 specific things to check right now, calibrated to these 3 signs and nothing else. First, run your retirement plan at a 3% withdrawal rate, not 4%, and model it starting at 62, not 65, even if you currently intend to retire at 65. If the plan fails that test, your contingency buffer is already gone before you need it. The stress test has to be done before the stress arrives, not during it. Second, determine whether you currently have 2 to 3 years of actual living expenses sitting in something completely non-correlated to equity markets. Not a balanced fund, not bonds that also fall in a crisis, cash or short-term treasury equivalents. If the S&P 500 drops 30% in your first year of distributions and you have no liquidity buffer, you will sell equities at the worst moment you have ever sold them in your life. The sequence of returns problem has exactly one reliable structural solution, and this is it. Third, healthcare may account for a significant share of retirement income. Paying about $12,000 to $13,000 per year in premiums per person can consume a notable portion of annual retirement income, particularly for households relying on withdrawals from savings or investments. Go to the ACA Marketplace calculator, enter your zip code and your projected early retirement income, and get an actual number before you set your retirement date. If that number is $1,100 a month per person and you have not specifically accounted for it, your withdrawal math is off by $13,200 per year. That does not fix itself through willpower or careful grocery shopping. It requires a specific allocation vehicle built before the gap opens. The real story of retirement failure in America is not people who did not save. Nearly 20% of American retirees are struggling or living the nightmare, according to a 2025 study from Schroders. Most of those people saved something. Many of them saved consistently and followed conventional advice. Nearly 51% of Americans worry they will run out of money when they are no longer earning a paycheck, and 70% of retirees wish they had started saving earlier. The problem is not mostly motivation, it is mostly mechanics. The balance number was adequate. The withdrawal mechanics were wrong. The sequence hit at the wrong time. The exit came 3 years early. And those three things together did what none of them would have done alone. Lazy investing built more fortune than crypto memes. And a plan you understand mechanically, even a smaller one, beats a larger plan built on assumptions you've never stress tested. The bucket is only half the story. The other half is how you hold it when winter starts.